And welcome to the ETF Edge portion of Halftime Report. I'm Bob Pisani. Interest rates are rising, the economy is recovering, and everyone who is holding on to high-yield bond funds wants to know what to do with them. Let's ask the experts. Steve Laipply is U.S. head of iShares fixed income ETFs. Isaac Braley is the president of BTS Management. He trades high-yield ETFs for clients. Steve, you oversee the iShares high-yield ETF. That's the symbol HYG. It's the biggest high-yield fund in the world. What impact will higher rates have on high-yield funds?
Well, Bob, thanks for having me. Traditionally, high yield has proven to be fairly resilient to increases in interest rates, and this year we're seeing very much the same thing. So far, high yield is outperforming the broad fixed income market by around 3%, and investment-grade corporates by upwards of 5%. So that trend continues. Away from increases in interest rates, fundamentals in high yield are actually improving. We're seeing default rates fall, and we're seeing upgrades outpace downgrades. So investors still need income, and high yield still looks fairly attractive.
You know, Isaac, the high-yield funds have held up relatively well under the theory that the Fed has pumped so much money into the economy that it is effectively ring-fencing some of the weaker companies that have issued high-yield debt, companies that normally would have been in a lot of trouble during that downturn. Is that correct? And when might the Fed's protection of those companies effectively end?
Yeah, I think from a trend of momentum standpoint, we've seen some weakness lately. With the Fed really backing as they are, we've seen most of that price happen already. I mean, you've seen huge reductions in spreads at this point in time. The Teslas, the Fords, the Carnivals of the world, all now paying significantly lower yields. You're having Tesla paying yields around 2.3. So a lot of that is currently priced in. And I think currently high yields are not that attractive. There's still great fundamentals going forward. We think by the year end, we're in a much better place. But a lot of the meat has been taken off the bone at this point in time, and you really need to be watching them very closely.
All right, gentlemen, thank you.